Ross from Coombe Property Accountants in Hamilton. Today we're going to look at minor dwellings. We're going to look at how a minor dwelling might work for you and what the numbers are on some of the minor dwellings. So I'm going to share my screen with you, and then hopefully you can see my spreadsheet up in front of you and you can see the different numbers. So how much a minor dwelling costs? It depends a lot on what area you're in, what your property is like, how sloping the property is, how much the development contributions are, and how much the other costs are, like stormwaters, driveways, that sort of thing. But we're going to work on about 220,000, which is sort of the average minor dwelling, about 200 to 220,000 in Hamilton. I always borrow the whole amount. So whenever I'm looking at an investment like this, even if you've got cash, I look at doing it with 100% borrowings. You need a return on investment, the money that you're putting in, and there's also an opportunity cost from investing the money into the property. You could invest it in the share market or term deposit or something else and also get a return. So yeah, I always work on initially 100% debt. Then we look at how many weeks is realistic for the property. It depends on where it is. If it's a really horrible location, terrible neighbours and things, you're not going to get 52 weeks. So you're better to use a lower number. If it's a really good location, new property, you should get 52 weeks. So I've gone with 52 for this example. What rent should you get for a minor dwelling? The best thing to do is talk to a property manager and tell them, yeah, the location, show them the plans, and then they'll come back to you with what market value is. I'm probably a little bit low on the 350, but I'm just trying to be a little bit conservative and show you an example. So the first sort of stat or information we look at is gross yield. So we go 52 weeks times 350, gives us our 18,200 of rent. 18,200 of rent divided by 220 gives us an 8.27% gross yield. So gross yield is just an indication. It sort of gives you a starting point. What is the cash flow going to be like? And obviously 8% is going to pay your 4% or less interest rates. So it means that, yeah, the rent is going to cover all the costs. It's going to be quite a positive property. You then look at all the different expenses. So your first one, accounting, generally you already own the rental property in front if you're doing a minor dwelling. So it's relatively cheap. Insurance, the same. You've got two houses on one title, so your insurance is a bit cheaper for the second one, maybe $750. Interest rates at the moment, we're borrowing at 3.55%, and it seems like it's going down. Property management for Hamilton, maybe 7.5% plus GST. Rates, again, you've got two properties on one title, so your rates will go up a little bit, but not a lot, maybe $750. It's a brand new house, so you wouldn't expect many repairs and maintenance. And then I generally allow a little bit of property education or seminars. You might buy some property books or go to some property seminars. You might join something like Waikato Property Investors Association, and then a little bit for travel. So basically you've got 18,000 of rent coming in, 12,000 of expenses going out. You're making about 6,000 a year. So this is a good cash flow property, good positive cash flow property with 100% debt. You'll then be able to claim depreciation on the chattels. So your carpets, curtains, dishwasher, stove, heat pump, all your other chattels will slowly wear out. So from a tax point of view, you normally use value it to value those chattels, and then so that we can depreciate them over time. So I've estimated about $4,000 just for an estimate. So you're making 6,000, less 4,000 depreciation. You've got a taxable profit of about 2,000. Say just for a standard couple, they might have one higher income earner, one low income earner, so they might be paying about 500 in tax. Look through some of my other articles. There's smarter ways to do this for tax. I'm not saying to do it this way. Obviously this example you'd try and put all the income flowing to the lower taxpayer, but this is an example on minor dwellings, not how to be creative with tax. So this property overall, you're making $6,000, paying $500 in tax, about $5,500 of positive a year with 100% debt. So you could then pay down some principal and over time end up with a property with a lower debt, giving you more and more profit. So yeah, to me, that's a great example of why you would do a minor dwelling. It's all about the cash flow. That's why you want to do a minor dwelling. The negatives with a minor dwelling is often it's what equity gain do you get? You're spending 220,000, but will your property actually go up that much in value? And that's a really hard question, and it depends, yeah, the area and everything else, but be careful that you're not spending a lot more than what it's worth. Especially if you go to a lower region where the rents are a lot less and the value of the properties are a lot less, you might spend the same 200, 220,000, but it'd actually not be worth that much. And the problem with minor dwellings is, yeah, it's two houses on one site, so it's an expensive purchase price for someone to buy, and it generally restricts the buyers. Normal home buyers won't buy it, new home buyers won't buy it. You're looking at investors or large families, and there's a lot less of them, so be very careful. The other thing I would look at for the property is what happens over a 10-year period. And basically with this property, even if interest rates went up, which is a conservative view over the next 10 years, because it seems likely they'll go down, but even if interest rates went up to 5% over the next 10 years, you'd still be making about that $5,000 or $6,000 a year after tax. So after 10 years, have 60,000 that you could have paid off the mortgage. And obviously, the more you pay off the mortgage, then the less interest you're going to pay, so the more positive it's going to be. So hopefully that's been useful for you and given you a great example of how minor dwelling could work, and maybe got you thinking, could you put minor dwelling on the back of your personal house or a rental? And just keep an eye out for our newsletter coming out on Monday or Tuesday, which is going to be about what's better, an 8% gross yield or 5.5. Hopefully you enjoyed that a lot. Thank you.